Hey Abby, how are you?
Hi, Tessa. I'm doing well. How are you?
Good, thanks. Thanks for taking this interview with me today. I am going to be the interviewer today and really looking forward to jumping in.
Likewise, very excited to do a case with you today.
Perfect. So in this case, Nike, the global icon renowned for its innovation in sportswear and athletic footwear, is currently facing a critical challenge. Revenue growth is slowing and is expected to decrease next year, 2025. In light of this, the board has stepped in to replace the CEO, bringing Elliot Hill out of retirement to take the reins. Hill is a Nike lifer who worked his way up through the organization for 32 years before retiring in 2020. The consensus is that Nike's situation is a consequence of prior leadership's strategic missteps, especially the over-reliance on digital channels that undermined traditional wholesale partnerships and eroded brand equity. Hill has brought in your firm to advise on how to best turn things around. Your task is to advise the new CEO on a turnaround strategy to rectify these past errors, rejuvenate growth, and restore Nike's position as a market leader.
Well, thank you for this, Tessa. Just want to make sure I understood everything correctly. So our client is Nike, the global footwear athletic company, and they're currently facing a challenge in the sense that revenue has been slowing and is expected to decrease next year. And so in light of this, the board has placed a new CEO to start, who is actually, a former lifer at the company, but he's coming out of retirement to help turn this around, which we've seen recently at companies like Disney and Starbucks, et cetera. So it sounds like they're kind of following in some of these more public announcements, footsteps, and doing something similar here. The consensus of their what caused their missteps is that prior leadership kind of made some strategic missteps, specifically over relying on digital channels and kind of neglecting their wholesale partnerships. And so they've brought in us to kind of advise them how to turn things around and how to rectify these past errors. Is that correct?
Perfect. Yep.
Just a couple sort of clarifying questions here. Does Nike have a specific goal in mind that they're trying to achieve, or is it just we want to rectify these past errors and hopefully turn growth around broadly, or do they have any specific targets in mind?
Yeah, great question. The board and Wall Street are both aligned that the company should attempt to maintain healthy growth, so 6% per year, and healthy growth margins of 45%. Over the past few years, the company has really yo-yoed between hitting growth or hitting margins, but has not been able to consistently do both.
Got it. Super helpful context. Another follow-up question here. And so I know we talked about these strategic missteps. Do you have any more detail as to what exactly those were?
Of course. So, starting in 2019, the previous leadership at Nike made three major strategic shifts. The first one was the elimination of categories. Nike aimed to streamline operations and reduce costs by eliminating product categories. So, for example, football or basketball, which each had their own product leadership. The company transitioned from that to a more standard model of men's, women's, youths. This change, however, led to the loss of vital expertise and innovation in specialized product areas, hampering the company's ability to lead in niche markets and diminishing overall product innovation. The second strategic misstep was an overemphasis on DTC channels. Nike sought to pivot towards a direct-to-consumer model by focusing on sales through Nike.com. The goal was to enhance revenue and control customer interactions. This shift sidelined wholesale partnerships, so for example, Foot Lockers or Dick's Sporting Goods, which were historically crucial for broad market penetration. And the shift also resulted in severe inventory mismanagement. And then the final misstep was shifting focus from brand marketing to performance marketing. And in this, the strategy was to drive immediate sales through digital channels by focusing on easy to measure performance marketing. The shift away from traditional hard to measure brand building eroded Nike's brand equity and hindered the long term customer loyalty. The shift also primarily targeted existing customers, which over time did fail to expand Nike's market reach and also weakened its competitive edge.
Got it. Thank you for that detail. Before jump into the case in more detail, is it okay if I take a few minutes to sort of gather how we could approach this problem together?
Please, yes.
Okay. So in order to sort of understand how we can help Nike, turn things around and fix these strategic missteps to kind of reinvigorate growth, there's sort of three main buckets of things I'd want to look at. First would be looking at our internal operations. Second would be understanding our market/brand positioning more broadly. And third, looking into our channels in a bit more detail. So first, starting with internal, I think there's three things within this I'd want to look at. A would be financials. So within financials, I'd really want to understand what's the scope of these, revenue declines, what products is it hitting, et cetera. Has there been margin pressure, et cetera? So really diving in, starting with the financials to get a sense of, where is this being impacted across Nike the most and what is the scope of the issues. That will kind of set our baseline and help us level set before we dive deeper into, what's causing the problem and how we can rectify it. The second thing I'd want to look at within this internal bucket is just our operations. What has changed as a result of these strategic missteps? So I imagine we may have had to, build new facilities. We may have had to change our website layout. We may have had to, change our supply chain slightly if we're maybe not doing as niche of products as were recently, and doing more broad-based products. So just understanding what we changed operationally in order to implement these strategic changes, because that will give us a sense of if we can easily reverse course or not, right? If we made broad-based operational changes, it would be harder. And then the third bucket I want to look at is what changed is just people. I would imagine like we kind of shifted from a product-based segmentation to what sounds like almost hybrid segmentation, right? You have like men, women, youth, and then you have probably sports within that. And so there was probably some reorgs that happened and kind of what's the state of our people today? How do they feel about this? And then as well as would it be easy for us to go back to the old way, et cetera? So just getting a sense of the people within Nike and how they were impacted by this. So that's the internal bucket. The second bucket, this market/brand positioning, a few things I want to look at. Firstly, I think understanding what competitors are doing. Are they focusing on DTC? Are they not? Why are they doing DTC? Did we just try to copy them, et cetera? Just trying to get a level set of where the market is going, because we can see if this DTC path was completely wrong, if our competitors are maybe not doing it, or if all of our competitors are doing it, maybe we can be differentiated by doing more channel partnerships, et cetera. Also kind of understanding customer preferences and what they prefer. Do they prefer to buy from Nike.com? Do they prefer to go to a third-party store, et cetera? So maybe there's a customer survey that we could run to kind of collect some customer data to understand, do we have to go back to full retailers? Do some customers like the Nike.com D2C, et cetera? And so what this would look like. And then the other thing I'd want to look at is just kind of new customer purchase funnel. So it sounds like one of the missteps was we were really growing with existing customers and not so much with new. So really understanding what's the purchase funnel for a brand new customer. Is that more likely to come online, in store, et cetera? What has it been historically? What is it today? And just understand how we can, try to increase our new customer growth going forward, because that seems like it's potentially a pain point for us. And then the third bucket I mentioned I wanted to talk about is just our channels, understanding, like looking at DTC data. So Nike.com, is there any silver linings? Are there any products that are performing better in the DTC model versus the old way of selling, for example? Because maybe then we don't want to shift from the DTC model for those products, for example. And then I also want to look at our retailers or channel partners that we stayed with and understand what's the current state of the relationship with them. Are they happy with us? Are they not? If they're not happy with us, maybe they're, not placing our products on as good of shelves within the stores, et cetera, and that's impacting things. But is there anything I'm assuming we didn't cut off relationships with all retailers. So the ones that we stayed with, like what's the state of those relationships? I'd want to look at, and then also any retailers that we did cut ties with would want to understand the chances of us potentially getting back into those relationships to open up more channels going forward. So that was a lot of buckets, but I think in terms of prioritization, it would maybe make sense to start with the financials and understand, the scope of this problem. So wondering if you have any additional financial data on Nike to understand the scope of the revenue declines here and what segments it might be isolated to.
Absolutely, I do. I'm going to share my screen here to an exhibit, which has just that.
Fantastic. Okay. So looking at this chart, it looks like we have revenue in billions, inventory in billions, and gross margin. And it looks like we have it over time from 2017 to 2024. Is it okay if I just take a few seconds to look at the chart and gather some insights here?
Of course.
Okay, so looking at this, sort of three key things jump out to me. One, starting with kind of the revenue trend, overall it's trending upward, which is amazing, but it has been choppier. So it's not a consistent upward trend, right? Like we see a decline in 2020 and then a jump up in 2021, likely some COVID noise, but kind of similar trends, right? Like mild growth to 2022, big growth 2023, flat in 2024. So it's just choppy. The second key insight is that gross margins have essentially been flat at around 43, 44-ish%, a couple outlier years, but generally around 43 to 44%. So that doesn't scream any alarm bells. I think probably more of a revenue issue here that we would want to focus on versus gross margin. And then third, looking at the inventory, we see a large jump in kind of inventory held from 2019 to today. It's almost 2 to 3 billion more held in inventory. That's likely due to this new strategy. I would imagine if we were working with more retailers in the past, we could kind of stuff those channels with some of our inventory, and which would we wouldn't have to hold on to as much as a result. Where now, if we're doing more DTC, we just probably have to hold on to more individual inventory at our facilities. And so that's my hypothesis as to what's going on there. In terms of, potential next steps, I think we got confirmation that the revenue has been choppy. Gross margins, nothing's jumping out. Inventory, I think this is kind of one of the bigger jump outs to me here, especially as it relates to the key question at hand. So I think it would maybe make sense to focus on inventory as a next step, kind of understanding why this went up, what's driving this, how we could potentially decrease it going forward, et cetera.
Yeah, absolutely. I completely agree with you that inventory is sort of something new that we actually didn't know about and the client didn't bring up to us. And so definitely looks like this is an issue. And would love to hear about investigating that increase in inventory on hand, as you mentioned, between that 5 billion to that over 8 billion that we see here in 2022 and 2023. And to actually estimate like what is the financial impact on Nike for carrying an additional 3 billion in inventory. I think that's a really important and interesting question that we can dive deeper into.
Yeah, that's a great question. Is it okay if I just take a few moments to kind of structure how I would think about this?
Please, yes.
Okay, so to approach this problem, I would like to think of kind of direct and indirect financial costs. So with indirect, there's things like the actual storage costs, as well as, operational or people costs to manage this additional inventory. You can't just have more storage facility without people managing it or operational processes managing it, et cetera. So those would be the direct costs. And then on the indirect side, I think you have depreciation and value risks. So if you hold more inventory, especially in kind of this fast moving, fashion world, even though it's athletic, things just turn over much, much more quickly in fashion versus say industrial goods. There's a risk of if you hold more inventory, the value to your consumers will depreciate over time. And some of that inventory you may have to sell at a discount or you won't be able to sell because it'll be out of trend by the time you get through it. So that's kind of an indirect cost. And then another indirect cost is just the opportunity cost of having to buy this additional inventory and store it on hand in a given period. So if I think about kind of how to estimate the cost, I would probably estimate, these buckets as a percent of the total inventory delta. So that would be about 3 billion of increased in inventory. So I would say, for example, storage is 10% of that inventory cost.
Mhm.
And I would do that for each of those buckets to get a total cost of kind of this increase in inventory holding expenses. Does that sound like an okay way to approach the problem?
Sounds fantastic. Yeah.
Fantastic. Okay. So if I kind of work through each of the buckets, so storage costs, I'm going to assume that storage costs are probably close to 10% of the inventory value at a given time. That's an estimate. Yeah. In terms of the people slash operational management, I would say it's probably less than the storage cost because there's some economies of scale. Like you're not going to have to probably hire an equal number of people or have an incremental value of operational expenses with each additional dollar of inventory. Like you're able to scale some operational processes like tech, et cetera. So I'm going to say, 5% of the inventory value there. Um, and then if I move on to depreciation, or the indirect ones, starting with depreciation, I would say probably, 5-ish%, maybe 10%, 5 to 10% you would probably lose in a given year just due to the fast fashion nature of things. And then if I think about the opportunity cost, I would say similarly in the 5 to 10% range here, just because that's kind of what I would expect you could earn if you were to just invest the money, right? Like you can invest in maybe bonds, low risk treasuries, et cetera, for closer to 5. You can invest in stocks or alternative assets for closer to kind of a 10% on average. So I'm going to say 5 to 10%, opportunity costs. So if I add up all these percentages, 10% for storage, 5% for people, I'm going to say 5% for depreciation. So that's 20%. And then the opportunity cost is, I'm also just going to say 5%. So that's about a 25% of the inventory value of 3 billion. So I'm just going to take the 3 billion times 25%, which would be about $750 million in
Mhm.
cost to them per annum. So my initial reaction to this 750 million of cost is that it's quite high. Um, Even though they're quite a large company with billions of dollars in revenue, 750 million rounded to a billion would be of their kind um, of a percentage of their revenue seems small, but this is still a lot of money and seems like it would be uh, something that we could potentially want to reverse going forward. If there's any way for us to hold less inventory and reduce these costs, would be a great thing for them to do.
Yeah, absolutely agree with that. And that's super interesting sort of methodology you have there. Here, I'll unshare. As you sort of think about those different levers that you had, those different cost levers, what would you say has the highest sensitivity, or what would you want to, investigate further or investigate first if you were looking into really getting, real life feedback or validation on the figures?
Yeah. So in terms of, biggest risk or things I'd want to investigate, it would probably be things that I would have the least control over. So I would imagine things like storage or, things like the operational costs I have control over. I can say how much I want to pay for a facility. I can negotiate with the people that own it or who I lease it from. In terms of operational costs, I can try to do, efficiency gains there, et cetera. And then in terms of the investment, I can choose where I like the opportunity cost, where I invest the money, et cetera. But if I think about one where I don't have control, it would be this depreciation bucket. The depreciation bucket
Mm.
would really depend on, obsolescence of the trends or of the fashion itself, which is more kind of due to consumer preferences. And so if I were to prioritize kind of biggest risks here, would probably be trying to understand what is the consumer's sort of average trend life cycle? Like how long can a product remain, on trend or something that a consumer wants to buy before it becomes less valuable? Because that will determine probably how much inventory we would want to hold of a given product. Because I also imagine there's staple products that we can hold more of. There's some where we want to hold less of because they're more newer designs, et cetera. But I think depreciation would be the biggest risk and one where I would want to investigate more. Specifically, investigating more would be trying to understand, the consumer life cycle of purchasing a product, and how that would inform how much inventory we would maybe want to keep on hand by product.
Amazing. Yeah, that sounds right to me. Speaking of risks, Nike's head of product is absolutely convinced that the 2019 switch from categories, so categories as we talked about, like categorized by sport, so football, soccer, track, to instead move to a more industry standard approach, which would be men's, women's, and children's lines of clothing, was a major mistake. Hill thinks that the head of product is correct, but is concerned about the costs and risks of reverting back to category-based organizing. What would you say would be the major risks and switching costs of transitioning back to category-based organizations after 4 to 5 years of the industry standard approach? And how do you think these risks can be mitigated?
Okay, great question. Is it okay if I just take a few moments to gather my thoughts here?
Of course.
Okay. So if I think about risks and switching costs, within risks, I kind of want to think of internal and external risks. Within internal, I think the main risks would be operational disruptions to our business just by, reversing course here and changing a strategy once again. I think a mitigant to this would be maybe having a clear implementation plan where we pilot, 1 to 2 categories potentially to roll out or roll back to this original strategy to start, and then just having clear communication with the company as to what we're doing and what the timeline looks like, et cetera, so that everyone's on board to try to minimize, operational disruptions in the form of like lack of employee buy-in, et cetera. So that's kind of the main internal risk that I foresee. In terms of external risks, I think we risk kind of having confusion by our end customers as well as our retail partners. If I think about end customers, they're probably going to be confused if their website changes again, if they start seeing Nike in stores again when they haven't seen it for a while, et cetera, and just kind of what is this brand doing? And then in terms of channel partners, I think they would also be confused if we ended relationships with them recently and then we try to turn them back on, et cetera. I don't know if we look like the most reliable partner. And so I think it's just this general sense of confusion by our external stakeholders, and that we maybe will come across as just not being super reliable. In terms of mitigants to those, I think it would just be clear communication with customers and channel partners about what we're doing as a company, what our strategy is, et cetera. Keep them informed on to, where product lines may have moved in terms of internal organization. Keep them informed about, keep them kind of informed on customer service that we provide during the transition, et cetera, just to keep them loyal to the company and that we care a lot about them. And so that's kind of the two main risks that I would think about. In terms of switching costs, I think I would think of these as sort of direct and indirect. If I think of direct costs, it's going to be the cost of the implementation to go back to the old ways of doing things. And so that would be things like you may have to do reorgs of people, you may have to change tech or rebuild your website, et cetera. You may have to, rebuild partnerships, support teams to support the channel partners, et cetera. And so those are the kind of the direct costs of this. In terms of the indirect costs, I would think the biggest one there is going to be kind of revenue and profit disruption, or I guess revenue disruption, in the sense of when we are changing, the way that we position our products or our go-to-market strategy, there's a risk that we lose sales during that transition process, just because it's harder to find what the customer wants, et cetera. Maybe when we transition from D2C to retailer, there's a period in between where maybe we don't have as much inventory for DTC channels because we pushed it to retailers and we lose some sales, et cetera. And so I think the indirect cost here is really the revenue disruption. And so if I were to kind of think of next steps, to me, considering these risks and the costs, I think the one that I have, the least amount of information on would be kind of the actual costs of this transition. And so a next step would potentially be trying to break out what the costs, both direct and indirect, would be of transitioning back to this.
Super helpful. Makes sense. Thank you. Perfect. You're presenting tomorrow to the transition leadership team for Nike, and it would be great for you to summarize your plan of attack.
Okay, sounds good. Is it okay if I just take a few seconds to gather my thoughts and look back at the case materials?
Of course.
Okay, so I recommend that Nike prioritize repairing their wholesale partnership or retail channel relationships to boost revenue and manage inventory going forward. So this would involve, moving back to what our previous strategy was before prioritizing DTC and directly engaging with retailers to offer them exclusive products, maybe some sales that they could offer, et cetera, and also pushing some of our inventory onto them to manage our inventory costs. This would have the benefit of giving, more consumer exposure to our brand. They see it in stores, et cetera, and that can help us win kind of new customers that aren't going to actively go to the Nike website to pick out something they want. But also B, this gives us, more channels to sell our product to, kind of increase volume of sales potentially, et cetera. And then we also get the benefit of we're not going to be holding as much inventory, which could save us, we calculated up to $750 million a year, just by kind of going back to this channel partnership model where we hold less inventory. A major risk to this strategy would be, causing confusion with our external stakeholders, such as customers or retail channel partners. Or another major risk would be just kind of operational disruption from this change and impacting our people, et cetera. But there are some ways to mitigate those risks, having clear communication strategies, explaining exactly what we're doing, having phased implementation plans, et cetera. And we would be happy to help you kind of develop a implementation and communication plan for this strategy reversal to make sure that all your stakeholders are on board. But in terms of today, kind of our recommendation to you is to prioritize, repairing these retail channel or wholesale partnership relationships to get Nike back on track.
Fantastic. Thank you so much.
Thank you, Tessa.
Hey everyone, it's Kenton Kavesti here, the founder of Rocketblocks. Thank you so much for watching this mock interview video. I hope you found it informative and helpful as you are getting ready to prepare for your own interviews and hopefully landing that job offer you are excited about. We have a ton of great content on the Rocketblocks channel coming out on a weekly basis, mock interviews, mini lessons, and chats with our Rocketblocks experts. So if you haven't subscribed yet already, please do so. There is a big red button below. And if you hit that, you'll get all of our content as soon as it comes out. Thanks for watching and have a great day.